Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over a lot of different information. I grabbed some from Twitter. I grabbed some from random things, just to show you kind of history. There's some price predictions that some people have that I disagree with, but guess what? I'll share them anyway, just to show you guys what they think, to get the opposite side of what I think. And we'll go through it here, and I'll give you my financial opinion as we go through it. So here's, it says oil, not bonds. The total returns after inflation, 71 to 1981. This is the total returns after inflation. Energy stocks killed it, 73%. REITs were 36%. And then you've got a whole bunch of stuff that's lost money in the inflationary period. The worst of the group was Treasury. The 10-year Treasuries lost 38%. Corporates were down 23%. S&P 500 was down 16%. Utilities down 9%. And Treasury bills were down minus 6%. And that is returns after inflation. Looking on the right-hand side, this is it, and I've shown this before. This is financial assets versus real assets under an inflationary period. So if we go into a stagflation environment or something like that, these are usually the commodities, how they perform under those inflationary conditions. Real assets and commodities do very well. Platinum is the precious metal that does the best under inflationary times. Real estate does well. Diamonds, gold, collectibles, United Kingdom farm, T-bills, cars, UK house, palladium, silver, art, U.S. farm. Silver was there too, above art, silver. And then the ones that do the worst are long-term government bonds, financial assets, large cap and small cap stocks, wine, stuff like that. Coming over here to Golden Coast, it took Bidenflation 15 months to become the worst since the last inflation crisis of Jimmy Carter. Stagflation 70s. And here's Joe Biden coming on up. This was Jimmy Carter back in the day. Good job at the Democrats is what this person is saying. On the right here, it says, imagine watching this and still thinking stagflation is here. This is the person who disagrees with stagflation. GDX has topped in wave 2 of major structure. Strong decline about to set in. No, we do not have stagflation. We have a temp spike in inflation, which will turn into the largest deflationary bust. He's been in the deflation camp, Henrik Zaberg, for at least 5 or 6 years. So I think that he's probably wrong. A deflationary bust, a lot of the time, the majority of the time, is led by a housing collapse, and we don't have those market conditions existent. And I'll show you later in this clip where the housing market really is. But we don't have the conditions for that, so I think he's wrong. And you can put all these numbers on the chart in terms of wave analysis. I will still disagree. He's been wrong for many years. And I'm glad that I did not listen to him in 2018, 2019, because I made some good purchases against what he was saying. Looking at economic cycles, just to kind of show you where we are in the economic cycle, we've got recovery phase, early upswing phase. This is basically a recovery phase to an expansion phase. They call it the late upswing phase. Economy slows, enters recession, and recession. Where I think that we are at is the transition between early upswing phase and the late upswing phase. So we're transitioning from here to here. And what that is, and the conditions, I'll go over the conditions here. So in the beginning or the recovery phase, this is the economic cycle, keep in mind. We have stimulatory economic policies. Think of stimulus packages in 2009. Confidence picks up, inflation falling. So this is 2009, 2010, 2011, 2012, 2013, 14, 15. That's this recovery phase. That's how long that phase is. It says short rates are low or falling, bond yields bottoming, stock market is rising, commodities start to rise a little bit, and then property prices are bottoming. So this was the early recovery phase of the last kind of crash. And as things come on up, what we see in the early upswing phase is increasing confidence, healthy economic growth, inflation remains low. We have short rates at neutral, bonds are stable, stock market is strong. We have commodities are starting to get strong. So think 2015, 16, 17, 18, 19. That's that phase here. And property prices start picking up. And the property prices started picking up kind of, I'd say 2015, 16, 17, 18, all in that area. Now, in the late upswing, that is when property prices start taking off big time. So we've got the boom mentality, inflation gradually picks up. Well, ours was hard. It hit pretty hard because of the stimulus kicked in on top of it. Policy becomes restrictive. Think of interest rates. So we've got short rates are starting to rise. That's what that inverted yield curve is talking about. The short rates start to rise. Bond yields start rising. The yields, not bonds themselves, the bond yields start to rise. And that's what we have today is all of this. Stock market is topping out. That's exactly what we're seeing. We're seeing a topping out of the stock market. Commodities rising strongly and property prices rising strongly. Now, this phase just started, I would say, in 2020, 2021. I think we have a couple more years left or more in this phase. After that phase, the economy slows and enters a recession. The confidence suddenly drops. Inflation continues to rise. Inventory correction begins. Inventory correction begins, and we have not anywhere near the inventory correction begins yet. We have short rates peak. Bond yields top out. The stock market starts falling. Commodity starts falling. And property prices tops out. We are not in this section yet. We are still, in my opinion, in the late upswing phase. And then recession comes in, confidence weak, inflation peaks, production's falling. We've got rates that start to drop, bond yields drop, stock market's bottoming, commodities are weak, and property prices are weak. We are not there. We are in this late upswing phase with property prices rising strongly. And I think we've got at least, we could have 4, 5, 6 years in this. I don't know the exact length. I just know that we're in the beginning of this late upswing phase. But those are the phases, and that's what you should be looking for are these different attributes during these phases in the markets. This is the global economy weighted inflation. And what could potentially happen here are home prices remain strong. That's your inflation driver. And the economy starts to weaken because of dislocations in the economy. So you could get this stagflation type scenario. Moving on up here, we've got more cycle phases. This is disinflationary and this is inflationary. We've got the reflation, which was the beginning over here in the recovery phase. The recovery phase is reflation. And the best performing asset class is usually bonds for this. This is also coming from a recession. So recession comes first. Your growth goes down. You want to be in bonds. They reflate it. And then in the recovery phase, you want to be in equities. That's your tech stocks. And then in inflationary, we want to be in an it's an expansion phase or the late upswing phase. They call it different things. Commodities is where you want to be, and that's exactly where we're at. And then under this, the stagflation is coming after. Then we want to be, they say cash. I say that precious metals is probably a good spot to be in one of these areas, depending on where you're at. If we get the reflation is good for precious metals, very much so. But they're also very good over here if it's a big inflationary period. Looking on down, we've got, and you know what? Higher interest rates won't solve the inflation problem. The problem is a lack of supply, a lack of workers, not excessive demand. And higher rates won't solve supply issues. The result, stagflation like Zimbabwe, weak growth, weak demand, but a very high inflation rate. And I think he's probably right on that. Because that's where my mind's at, and that's where I think we're heading. It says, unrelated to the global semiconductor shortage, it says parts shortage halts production of Chevy Corvette next week. The production halt comes after the plant halted production the week of March 21st, also due to unspecified parts shortages. And I think we're going to see a whole bunch more of this in the future of part shortages in a wide variety of things being built in complex assemblies. But I wanted to touch on that. We're looking at coming up here, it says, U.S. Insights, CPI rent gains to step up sharply in the next 6 months. So that's rent gains, the consumer price index rent gains. Rents demanded of new tenants continued to increase at double-digit rates in March, according to Yardi Matrix. These sizable increases in asking rents signal faster gains ahead in the main housing-related component of the CPI. Because those components make up almost 1/3 of the overall CPI, the faster increases there represent a substantial headwind to the slowing in overall inflation that both the Fed and Bloomberg Economics expect over the rest of the year. A model that maps one of the Yardi's indexes into the relevant CPI components anticipates that by September, the CPI component for renters will be rising 7.4% compared to 12 months earlier, up from 4.4% in March. And the CPI for owner-occupiers will be rising 6.7%, up from 4.5% in March. So this portion of the CPI index will be rising faster than what it was beforehand. So this is kind of a leading indicator. This is obviously 1/3 of that overall CPI. Looking at this, we've got core inflation deviation from inflation target. The EM core inflation is very high, and these are different inflation areas of different currencies. USD is right here. That's where it is right now, but there's a little bit above it, and there's a couple deflation. And it says, but the output is weak. So we have inflation on the currencies, and our output is low. It is not like the trend line since 2018. It is falling down like this over here and falling behind for actual GDP. This is India for this particular instance. We also see more shortages I wanted to talk about. Nissan halts production at Russian facility, citing parts shortages. Toyota halts Japan production after supplier hit by cyber attack. And then we've got Foxconn halts production at Shenzhen, goes into lockdown. We're getting all these shortages in parts for random things. Like I'm showing cars here because they're complex assemblies. I have a feeling that we're gonna have part shortages across the board in a whole bunch of different things. And this is just the beginning of it. And then on the right here, I've got the number of unsold finished new homes per community. So this is finished new homes that haven't been sold. This is the matched builder responses year-over-year national average. So back in 2019, this is a tight market over here. But look what's happening. We don't have any homes to sell that are finished and new. They are declining to record lows March of 2022. So what this is saying, I know we saw some information about a large amount of homes, of new homes, inventory. What they're looking at is they're looking at the unfinished homes in the pipeline of new homes being built. This is what it looks like on the opposite end of the finished homes that are built. They don't exist. They're all purchased. So we have what we're seeing across the board here is we're seeing tightness in the overall new home market. We're seeing tightness in the active inventory of existing homes. And then we're seeing rent prices skyrocketing. It just means we have a home shortage. Now, I know what they try to pull this off. This is what they try to pull. They say, we don't have a structural deficit of homes. And then what that means is that we have enough homes to house all these people. But there are people who own multiple homes. I don't really care. I just look at inventory. And what are we going to do? Steal these homes from these people? Is that what the plan is? That these people, that we don't have a structural deficit of homes, that we're just going to take these homes from other people? I'm sorry. I don't agree with that. That's personal and private property. And one of the things that makes us unique and human is to protect private property because we're not a bunch of thieves. So, I mean, that's my take on it. But I don't think you can count those homes if they don't exist on the market. If they're owned by somebody, they're not fair game. But that's the way that I view it. Some people are dramatically, on one side of the camp there where they're willing to take personal property, and I can't go that distance. If someone put in the time and the work and the effort to acquire it in the first place, and I don't care if it was given to them by their heritage family, that does not matter, because that money could be there and saved for that particular purpose. You can't take someone's labor and just dismiss it. That's completely unacceptable. And if you have that viewpoint, I'm going to be pretty harsh. We should take your labor and see how you like it if your labor goes away. I mean, it just does. I do not like that mentality or thought. Just because someone has created excesses in the market does not mean they're bad. In fact, it means they're the best people out there. Why? Because they sacrificed themselves to create more value in society and more utility in society than what they've taken out of it, which means they've made the place a better world. So to have that opposite viewpoint is lacking a little bit of the IQ points, in my opinion, because I'm very strict on this. And those that accumulate vast amounts of wealth obviously have goods and services that everybody wants to use. So they're increasing the utility and the happiness of humankind in the entire world. And that's just one viewpoint. I mean, obviously you can disagree. If you want to take a crazier standpoint, then go for it, whatever. But I just wanted to make that last comment there just for the heck of it. All right, guys, give me a thumb up for the content. Subscribe to the channel if you haven't. Subscribe to my website. The Platinum membership gets you all my opinions. And I usually do a video or two throughout the week, giving updates on what I'm looking at when I'm potentially purchasing. And I also give other potential buys in other areas that I might be not purchasing just because I've overweighted it already. But I give that opinion, and you guys can choose which ones you guys like, obviously. And I think it's a good service. Obviously, I don't give buy points like in terms of specific price targets. I'm not a price target type of guy. I find a trend, identify a trend, see if the trend's broken, and then I buy that broken down trend, and then I let it ride so long that the market conditions are good. I don't put price targets. I don't put exact little movements. Why? Because it doesn't work. That's why. It does not work. And these people who put all these price targets, they're crazy. That's the way that I view it. Play the trend, get as much as you can out of the trend, and then get out of it when the trend is done. And ride it. Even if there's large volatility, I'll still ride it as long as the trend is good. All right, guys, we'll catch you next time. This is Finding Value.